Okay, good morning, everyone. It's March 1st, 2023, that time of year again where we're here to have our personal tax tips in 2022 tax filing webinar. So welcome. My name is Barbara da Fonseca. I'm the principal of BDCA Chartered Professional Accountants, and presenting with me today is Paul McVean. Paul McVean is a Chartered Professional Accountant, as am I. He's also a trust and estate practitioner, as well as a certified financial planner. So you're in good hands with us today, don't you worry. Between the two of us, we've prepared and reviewed thousands of returns over the years, as well as had many dealings with CRA, successful ones. Yes, so we will get started, but first, just a few housekeeping items. The webinar is being recorded and it will be available on our website, hopefully next week, if not the week afterwards. We have muted everyone's microphones just to prevent any unexpected distractions during the presentation. And if you have any questions, please feel free to use the chat function. There's a chat icon on the Zoom menu bar that will allow you to ask a question. And if you could please choose to share it with everyone so that everyone can see it, just in case someone else has the same question, so that we don't have three people, writing the same there and flooding the chat box. So thank you very much. And we'll get here onto the next slide for us to see. Okay. And I'm just going to stop sharing just for one moment. Okay. There we go. Okay. So there's another, that's Paul in his younger years and me in my younger years. Okay, so the agenda for today, we're going to go through the basics as who has to file and why should you file if you don't have to file. Some new information for sole proprietors, credits and deductions that are available for them, and some info on that SEBA loan that many sole proprietors obtained. Some information for individuals, which of course includes sole proprietors, such as the first-time home buyers tax credit, the home accessibility tax credit, labor mobility deduction for tradespersons, which is new this year, the Ontario Seniors Home Safety Tax Credit. There's a few in terms of medical. There are additional surrogacy medical expenses that can be claimed that will go through, as well as the new Seniors at Home tax credit and an update on the disability tax credit. There's the Ontario Jobs Training Tax Credit, the Ontario Staycation Tax Credit that you may have heard of, and then finally the Ontario CARE, which stands for Child Care Access and Relief Tax Credit. We'll also be giving you a little bit of a CRA update, what's going on with the CRA these days, discussions about the COVID repayment, the underused housing tax return. You've probably heard about that. We'll go through that a little bit. A new first home savings account. We'll give you some information on that, as well as a refresher on some RSP rules. We'll discuss rental properties, investments in cryptocurrencies. We all know that there's a lot of investing activities going on and a lot of buying and selling of many different kinds of cryptos. So we'll go through that. A quick recap on the home office expenses that can be claimed. There's a lot of information for the home office expenses, so we're just going to highlight the few key things, but you'll have the slides to take away with you, which will also be available on the website next week. And then just a few other admin items. Okay, here we go. So who has to file? Well, if you owe taxes, you definitely have to file. If you're entitled to the Canada Child Benefit, if you applied and received the Canada Workers Benefit, if you dispose of capital property, even if there's no gain, even if there's a loss, or you had a capital gain in the year, you need to file that tax return. You have to repay some or all of your OAS and EI benefits. You have not repaid all of your home buyer's plan or the lifelong learning plan. If you have self-employment greater than 3,500, you now owe CPP, so you have to file that tax return. If you stopped being a Canadian resident If the CRA has sent you a letter, a demand to file, you must file a tax return. But one note on that topic here, the demand to file, many of us have now opted for online mail from the CRA. Once they place that letter online, so not in the mail, you've now received notification via an email sent to you. So it's really important to check your CRA emails because there could be a letter there and there could be some taxes owing. So it's really, really important to check those. If you have elected to split pension income, and if you elect to pay EI on self-employed earnings. Ensure to file so that you can recover refund if it's owing to you. If you'd like to receive your government benefits, you got to file your tax return. And of course, if you want to generate that RSP room, TFSA room. So what's new? So for sole proprietors, there is a new immediate expensing rule that is optional for when you purchase certain kinds of assets up to $1.5 million. So for those of us that are self-employed, if you purchase some furniture or appliances, tools costing more than $500, a new computer or a photocopier, things like that, you can choose to expense the whole thing this year. Now, 2022. Previously, you had to capitalize it and you'd get what's called amortization or depreciation for tax purposes over a certain number of years at government specified rates. Now you can opt to expense the whole thing. The asset must be available for use before 2025. It must be purchased from an arm's length person, so not your wife or your brother, and you must be a Canadian resident. If you choose to write off the asset, it cannot create a loss for the business. And if you don't use the full $1.5 million this year, you cannot carry it forward to next year. However, next year you'll have a new 1.5 million limit and each year until 2025. So does this mean that you want to expense it all this year? Well, it sounds good. Of course, we want to save taxes right now, but perhaps if you're in a 12% personal tax bracket this year, and you know that next year you're selling your cottage and you're going to be in the high tax bracket due to a large capital gain, then you probably want to save this to next year so you can save taxes at, say, 50% instead of 10. It's a significant difference. So this is a great new deduction that's available for sole proprietors. Another new tax credit is the Air Quality Improvement Tax Credit. Again, it's for sole proprietors. It's a refundable tax credit equals to 25% of the total ventilation expenses or your HVAC, whether you're installing or upgrading your HVAC systems. And the qualifying expenditures or the HVAC expense, ventilation expense, starts from September 1st, 2021 and it ends December 31st, 2022. You are allowed up to $10,000 per location, up to 5 locations. So maximum you could save is 25% of the $50,000. And just keep in mind, this is a refundable tax credit, okay? So this is a really good one. And finally, the CEBA loan. Some of you received a $40,000 or the $60,000 CEBA loan. A reminder, in order to qualify for the loan forgiveness of up to a third of the amount, so either it will be the $10,000 for the $40,000 CEBA or $20,000 forgiveness if you receive the $60,000, you must repay the remaining amount before December 31st, 2023. If not, the outstanding loan automatically converts to a 2-year loan on January 1st, 2024, which must be paid by the end of 2025. When you received that loan, it was taxed to you already, the forgiveness portion, so that should have already been handled by now. And yeah, so this is a good one. And we'll see how the CRA will audit these, if anything, right? We suspect they will. I guess the question is when and how. Because we know when it first came out, it was very easy to qualify for this. All you had to do was click a few questions on the internet in your bank and you would likely receive it. So what else is new? Well, the first-time home buyer's credit itself is not new, but it has increased to $10,000. So now your credit would be $1,500 if you're an eligible home buyer. Just remember, you could not have lived in another house that you or your spouse owned in the year or any 4 years prior in order to qualify. And this last criteria is waived for those that qualify for the disability tax credit. The home accessibility tax credit, not new either, but it has increased to $20,000. So that means it's a maximum tax credit of $3,000. Eligible expenses must be directly related to a qualifying renovation. So for those of you that, whose parents have moved in, or someone else that qualifies, this is really something to consider. What qualifies? Eligible expenses, building materials, fixtures, equipment rentals, etc., that you could have paid for, but not your labor. You can't figure that, okay, I would have paid a third party, I don't know, $60 an hour. It took me 25 hours, therefore I can also deduct this labor. No, you can't do that. But if you did pay someone else the labor, that's fine. You can deduct the labor then. But if that person was a family member, someone related to you, they must have a registered business. And if you see there, they must be registered for the GST or HST. And a qualifying or eligible individual is approved for the disability tax credit or over the age of 65. Okay, so you could technically claim this if your parents moved in that either qualify for the disability tax credit or 65 years of age and older. So this is another one that I think will be big this year. This is new for tradespeople, a labor mobility deduction. Okay, so the eligible individuals, tradespeople and apprentices working in the construction industry. It is a deduction for a temporary relocation. So you're not permanently moving to a new city to work as a tradesperson or apprentice. It's a temporary relocation. You deduct up to $4,000 in eligible expenses. And if you are able to claim the moving expense deduction, you cannot also claim this one, okay? It's one or the other. Ontario Seniors Home Safety Tax Credit. It sounds a little bit like the others, but it's a third one. And it's new. It is refundable, so we really like the refundable ones. It's refundable. You get 25% of up to $10,000 in eligible expenses for a senior's principal residence in Ontario. You're eligible if you're age 65 or older by the end of the year, so the end of 2022, or if you live with a senior relative, or you will live with a senior relative within 24 months of incurring the eligible expenses. So that's another big one. And the eligible expenses, grab bars, related reinforcements, tubs, showers, walk-in bathtubs, wheelchair ramps, handrails and corridors, even automatic garage door openers to make it easier for seniors to get in there, touch and release doors, motion activated lighting. There's numerous more specific details, but these are just some of them here. Another on Ontario Seniors Care at Home Credit. So this is for low to moderate income seniors with cost of eligible medical expenses. Okay, so they are eligible to claim this refundable credit if they turned 70 years of age or older in the year, or they had a spouse or common law partner who did, and resident in Ontario at the end of the taxation year. Okay, so December 31st. Also, in terms of what's new for medical expenses or medically related credits and deductions, is the medical expense tax credit now includes more in terms of surrogacy and related expenses. So amounts paid to fertility clinics, donor banks, will now qualify if it's for the individual or the individual spouse or common law partner, even for a surrogate mother. And also certain expenses incurred in Canada for the surrogate donor will also qualify. So this has really been expanded. And I'm just going to take a minute here to put on the screen. You should be able to see this. This is a list of medical expenses that qualify here. It's very handy. Like, for example, it's on the CRA's website, and it's very handy if you'd like to know what qualifies, because there's so many things, right? For example, I can type here, diapers. Yes, it qualifies. But when does it qualify? And do I need a prescription? Yes or no? Do I need it to be approved for the disability tax credit to qualify for this? No. So this is a great one. This is a great tool for you while you're gathering your receipts, and it's on the CRA's website. The disability tax credit. Previously, individuals diagnosed with type 1 diabetes did not qualify, but now they have, which is great. Okay, so, and this is for 2021 and later tax years. So, and even if it's you do qualify, but you didn't fill out your forms for the last few years, and it doesn't have to specifically deal with this diabetes, but you value the rules, actually up to the last 10 years, you can still get the disability tax credit form signed and sent into the CRA. It's like for your consent to easily upload it in the CRA system for you, and you can actually get any monies owing back to you for the last 10 years. A reminder, just in general with medical expenses, they must be paid. So if you have an account with your dentist and you pay every 6 months, well, they pay almost 10 to do, then you might don't forget, you can pay us. Travel insurance and expenses off here, public travel, Canada. We don't forget to do that for years. When we request required to have there's a penny there, we'll that also available. And it's still here, the patient site there, or in their website, or if we send you also to get till later, you can see everything that's available for the vast listing for medical expenses. And offering credit. It is available and it's refundable, temporary. It was also last year, but extended for 2022. And for 50% of eligible expenses for the year to a maximum of 1,000. And again, eligible expenses are fees for occupational skills, trade or professional exams, post-secondary education courses. So essentially, if you had eligible tuition fees federally, these will provide you with this Ontario tax credit cash up to $2,000. This is another good one. Staycation tax credit. Those not to travel simply couldn't due to the COVID situation in 2022. So the Ontario government introduced this staycation tax credit. It is only for 2022. It is not available for 2023. It is refundable, and it is for a leisure stay of less than a month. So if you rent a summer cottage for 2 months, it does not qualify. Less than a month. Now what qualifies? Hotels, motels, resorts, lodges, cottages, everything that you see there. Bed and breakfast, campgrounds as well. So you can be camping. But it's for GST or HST. So that's critical. You need seats, of course, like anything else, to claim your tax return to support this. But if the supplier's not registered for GST or HST, you cannot claim it. So that's just one thing to really, really keep in mind while you're gathering your documents for your personal tax preparation. 20% of the eligible expenses in Ontario can be claimed for an individual or for your eligible children. So you'll get back up to two minimum 200 or maximum 400 as long as you spent the $1,000 or $2,000. You must be Ontario resident on December 31st, 2022 in order to qualify. And the actual stay needs to be during January 1st to December 1st. However, if you paid for it prior to then, you paid for that stay early or afterwards, it still qualifies. The Ontario Child Care Access and Relief from Expense Tax Credit. This is another major one for lower income earners. It is a refundable tax credit. Families with up to income of $150,000 will qualify. It is quite significant. It's very similar to the federal child care expense deduction. And like the federal child care deduction, the lower income earner must claim this. It's a separate Ontario form, and it's actually calculated as a percentage of the federal child care expense. And here's just a rate chart. So for those of you whose family income is up to $20,000, that's the simplest example here. Let's say you had $10,000 in a federal child care deduction, you get $75,000 cash back. You file your so that's why you've got to file your tax return to get that refund. And there's all the other brackets. Of course, the more you make, the less you get, but it is refundable, and it's a good one. We all know that child care is quite expensive. If you don't qualify for subsidies in regular daycare, this is another way for the government to try to compensate you. Okay, so is the CRA going on strike? The staff have been without contract for over a year. Already started voting. The voting continues until April 7th. So here's a problem. If they go on strike, we've all got problems. Shouldn't be laughing, but so what do you want to do? File as soon as possible. Try to file before April 7th. Try to get your information as soon as you can. There's no guarantees that the CRA would give an extension. Phones might not get answered. Paper returns most definitely will be delayed for processing. So please, try to send in your information sooner this year. Again, it's very possible they'll go on strike. In terms of CRA service standards, so what's going on over there? Well, their goal when we file e-file a T1 return is for you to receive a notice of assessment in 2 weeks. And that's only if your return was filed on time. I'll know that everyone here in this meeting and all Canadians file on time, right? No.
We wish. And in terms of T1 paper returns, the goal, CRA is to issue it within 8 weeks of receipt of a tax return that's been filed again on time. And if you're filing a GST, HST for your sole proprietor partnership business, their goal is to issue the notice of assessment within 4 weeks, and again, if that's been e-filed online. There have been many complaints over the last few years about CRA wait times. As of this morning, if you have a personal tax phone call at around 8:30 in the morning, the wait is 30 minutes to an hour. That's the personal tax hotline. They're already getting the personal tax regular line. So they're already starting to get really busy. I did call the corporate tax side of things this morning, and after hitting, 3, 2, 4, 5, and all the options and insist on getting a live person, within 1 minute, the corporate was available. So personal tax is really starting to get busy already. Another reason for us to register online if you haven't with My Account. It's a great service. You can get all your information there that you need to. And the CRA, they had introduced and they still have a callback service that's offered. And it's offered when wait times receive a certain threshold that they determine is too long for us Canadians to wait to with a live agent. There's the phone numbers for you. So individual income tax inquiries, you can call that number. And there, if the queue is too long and there's too many of us waiting in line, this automatic callback service will trigger to give you that option. And for benefit inquiry, there's that phone number for you. In terms of CRA letters going out and asking for backup, there are two different kinds. There's audit campaigns and review campaigns. The audit ones are more intense. The review are less. In general, we know they just want to verify the information that we have submitted electronically to support the claims that Canadian taxpayers have made, that all of us have made. We have seen in the last year or so continual reviews of the foreign tax credit claims on individual returns, donation claims, medical aids, even if you qualify for the disability tax credit, even if you're 90 years old, even if you sent to the CIC or $40,000 you could claim as medical, they might ask you again. Medical expenses are major. Vehicle expenses, as another one we've been seeing quite a bit, and payroll. Okay, so a lot of audit review campaigns going on. And of course, the CRA has been really pushing for online services. They hesitate to mail as much as they used to, and you asked to not receive paper anymore. So please remember to check your notifications from the CRA that there's new mail. And one new question that we're asking you on our personal tax checklist that CRA is asking you and CRA is asking to ask you is this last question on the screen here. Do you authorize the CRA to share your name, email address to Ontario Health for the purposes of being contacted by email about organ and tissue donation? Okay, so that's a new question this year, and we will be asking you the answer as to how you'd like to answer. In terms of COVID-related items, some Canadians had to repay the COVID subsidies or benefits that they received, and you are able to deduct this repayment. You pay tax on the income, and when you repay it, you're allowed to get a deduction for it. Now, there's a form that we have to fill out in order to do so, and you can advise us to either claim it this year or in a prior year, or we can even split the deduction. But it's important to remember, if you repeat this, please do notify us. We can make sure that you get your deduction. And finally, T4As, for those of you that received a few COVID benefits in 2022, most of them were phased out, but some of you may have received some in 2022. Again, they will be reported on the T4A. Okay. And now I'm going to hand it over to Paul to continue on.
Good morning. Thanks for listening in today. It's always my pleasure to speak about tax, and even better if I have an audience to do that for. I'm going to carry on with the presentation with a few more new items and then some reminders about various other issues and topics relating to personal tax. The first one I'm going to speak about is the new underused housing tax, and this is a 1% federal tax that applies for non-residents holding Canadian real estate that isn't being properly utilized as per the government's in higher density population areas. The idea here is that non-residents may have been purchasing a fair bit of Canadian real estate and just holding onto that real estate, looking for some appreciation, and not necessarily looking to rent those properties out or have people live in them, which in turn has caused the Canadian real market, particularly in a few areas like Toronto and Vancouver, to increase a fair bit. So this is our government's attempt to cool that housing market and have this tax apply. There's a separate return that is due April 30th of each year following, and this April will be the first deadline for those who hold such properties. There's a significant $5,000 individual fails to file. There are, I guess, 3 categories of real estate ownership where we need to consider the applicability of this tax. First, if you are a Canadian resident and you hold title to Canadian real estate property, the tax does not apply to you. If you're a non-resident holding Canadian real estate, and the tax does apply. The third area is a little bit trickier. This is where you may hold Canadian real estate but not directly in your own name, and it may require a return to file even though the tax may not apply. Where it arises is in cases where you have trust or corporation on real estate that may cause this return to file taxes. Right, we talk here about property trust and so let's say you have property held by one sibling, who does not have capacity or has a personal tax that from the property owns, because the resident owns down, and another resident who's not really a resident, but the only resident who's then you actually file. So this is an issue that you have to taxes. This is the first thing to lower active against this of same tax that is available. So this is a vehicle that is over 8 years of age or older and who wishes to save for their first home purchase. There's $8,000 contribution starting this year, maximum $40,000 in lifetime. Unused contribution will carry forward $20 fees. Get a tax deduction when you make a contribution. But if you put money on your qualifying withdrawal, then that income, then the withdrawal will be taxable, much like our scheme once again. Currently, the FHSA is not taxed, and if you do withdraw, you don't regain contribution space. You can transfer it to a measure savings vehicle. So that is an option. And you have both the FHSA as well as using the home buyer's plan where you withdraw from your RSP. We cannot use both programs for the same qualifying home. So you may have to make decisions on whether to stay in the FHSA or the home buyer's plan with your RSP because you cannot use both. But that's the opportunity to save for ownership. Hopefully, make that more affordable for those otherwise it's relative to a down payment. RSP as well. You see the first point here says not over 3. This issue arises every year during our tax season where we look at RSP contributions, and every year we find you who contribute more than the limit allows for. The limit for each is $1,560. So you use limit for 5 years. If there's over contribution, there's a 1% penalty until you are no longer in contribution position. This may require extra find funds from your RSP or wait until the next calendar year when the RSP space becomes available. You have a better contribution position. So if you discover that you're in a contribution position preparing tax returns this year, you might want to take action to fund some of the RSP and now you're way down going 1% penalty. There's a self-reporting question we get about the and that's why I have to basis. One big tax planning question around RSPs is whether we claim a full deduction in a year or not. When you contribute your RSP and you stay in your limits, you are eligible to claim a deduction for up to the full amount of contribution that you made. So you have to pay the entire amount contributed as a deduction this year. So if you are asking for tax rates, we'll come back to this topic. When we come back to this, you start claiming now. They have to determine or there's some rules around, but I'm actually claim and they're into capital properties and not claim capital cost allowance for tax purposes that would create a loss. So you capital cost allowance to reduce profit to zero and not go below. Claim depreciation on property. There are certain considerations you need to be mindful. If you rent out a portion of your home and you want to be able to claim the capital for the residence exemption when you sell, then you not claim depreciation on your property as a rental expense. Likewise, if there's a property you rent out to a maintenance moving to and become your personal residence, you may not want to claim depreciation. Likewise, if you rent a property and you then use it personally, you claim depreciation. We might be issue that prevented from claiming the person's exemption in certain years that you own it. What we're doing, we have claim capital cost allowance if the property may become personal use as in the past. Property sale. We see a lot of activity with vacation properties these days, and when a state property is sold, you have to determine whether personal residence exemption applies because you only claim that exemption on any property that you get a year, and that claim has to be shared with yourself, your spouse, or common law partner. If the property is taxable, then we want to calculate capital gain. The way we do that is we consider the sale price, which then deduct any of the sell costs, legal fees, and fees. And then also deduct the adjusted cost of the property, which the original gain plus the additional fees that were incurred at the time of purchase, legal fees, rate, tax, and if you improve the property, that would add to the cost base as well, post purchase. And then $500,000 capital gains exemption that disappeared. And for those who own capital properties such as real estate projects like that, there's an opportunity for that exemption to way to bump up the cost base of the property by using the remaining balance of that $1,000 exemption. We would want to know if you are selling property now, if you own it in that if you have claim that exemption at the time. Next slide. Investments. During personal taxes, obviously, we see a lot of investment activity for the previous year. One of the tricks with investments is the return on investment. The average tax rate for the year and if you are buying and selling securities or investments in foreign currency, you can lose a lot. You can cost of property, you can pay things like market securities, and you're like 7 days to foreign exchange. So you can the cost of paying that sort of ways to process that credit, which is paying capital you lost. You can cost of paying that currency. You also pay US capital for the gain so that's the other currency. But anyway, that's actually cryptocurrency. If you are dealing with cryptocurrencies, there are determinations as to how you acquire it and how you are using that currency. And the different ways you may be using it could result in capital gains and losses on selling cryptocurrency or maybe business income or loss, depending on the underlying use and how you acquire it. It goes beyond what we covered in the presentation as well as specifics there. But if you're trading in currency, you are buying crypto, you are likely to be running a business or at least carrying a measured nature of trade, which is then taxed as ordinary income, so taxable and capital gain loss. If the total income are intended to trade that currency, then it means on capital gain loss, which is probably all our taxable or taxable as other capital gains. If you don't participate, look at this link and read that much more on crypto, or of course you can read that much more. Moving on to employment expenses. There is a usual way that for all qualify that calculate the specific expenses that you had report on tax return, but the COVID is more working from home at certain times. Again, we came up to why that's another point. We've got a bunch of slides here that detail a lot of information for you. I'm going to touch on the main highlights, but if you read that as I wish, I can go into more details. So looking first, that's simplified. That is a temporary flat rate, and the way this works is you don't have to keep track of the actual expenses. You just claim dollars per day as a deduction of a maximum of $500 per year, which equals 215 days. And you're ready to deduct that. You need to work home more than 50% of the time for the 4 to 7 weeks to start on those days, and you don't have to calculate the cost before required. And if you choose to support that, not claim the other employment expenses. But if someone from home has no money, that month that number 18 cover actual work and weekends, vacation days, things like that. Might be your full time hours that you work from home. The detailed methodology relies on you to keep track of your actual expenses and then correlate for the size of the home expense relative to the size of the home. So you're always taking of your costs that are eligible as a deduction on your tax. You may have further program not so much that the next slide. Let's see. Next slide. Those are something. See how inside the cost that are taking place. The portion on the fees in that maybe one of your costs with if you're initially you're from assessments to your income. You may also claim insurance properties. So your salary point by times with your education way, then you don't have to pay further taxes. This is definitely possible. So we leverage this, but possibly exemption. Always important to place. So think about what you're doing, and that's for sure. For that capacity. So also actually say that the criminal sense has so that claim is already the cost to control. There's some explanations. If you're self-employed or working for to then maybe you're out of the home to as for employment that is personal, not federal. There's next slide. If you are claiming for if you're claiming the detailed method, then you need a 1420 from your employer that authorizes you to make the employment expense claims. The employer relies on the employment to indicate that you are accountable. So does review these claims very often, so it's important to have the paperwork done in file in our hands, so CRS to see if you have any account. As you see this chart here, the different requirements to simplify versus the method that first choose that you use. So the method is not to calculate both methods and choose which version actually delivers the greatest deduction tax. If we do that, the amounts are very similar. It may be more work than necessary. So if you think that the detailed method will result in similar things as the simple method, easy to choose the simple method and worry about all these things. And detailed method also the that's what you're actually makes sense to do that. Okay, before we move on to slide 35, please. A couple tables here for you to see how you tax rates look like in 2023. This table here shows the total rates that apply for various kinds of income that may be earned after carry over. Now, you see ordinary income that differs. So employment income, withdrawals from your RSP or with pension income, foreign dividends, or 40% of your investments, or any one of those. And carry over rate 53.5%. Capital gains have a 50% inclusion rate. So the tax applies to capital gains is half of the ordinary amount. Capital gains are paid by companies or private corporations in Canada that pay tax above the small business deduction on their capital earnings. If you have a private corporation and you earn more than $500,000 in business income per year, you generate what we call net available, and where a private corporation has available net dividends. Non-dividends are typically paid by private corporations where their business income or bigger income from investing or resources that any corporation can have non-dividends by default. We have carry over rates. I think there's something to consider here. You can see the different marginal tax brackets that apply to carry bunch when we get interaction between the federal rates, the provincial rates, and the provincial taxes. We have a lot of different brackets, so we range from paying tax at 11% up to close to $1,000 a year, up to 53.5%. So you can save on income or $235,000 in change. One of the things that this table is good for is the idea of claiming the RSP deduction now or in the future. As you claim after reduces your income, the amount of tax saved may be broadening as you follow the brackets. So one of the things that we look at more is how much income you're expected to have in future years compared to this. So let's say I have $100,000 this year, you get $10,000 income. If you're not this year, you tax 43 or 4%. The next year, your income is going to be higher for some reason. You might save tax at 53.5%. So right, get an extra 10.5%, there's 12% more savings available to lay in deduction in the future year if you make the higher tax rate. So we use the tables to look at how much savings you have a year from now to years from now today. So I need to use the table. Another thing that the table other income would be for the monthly income, and that income is also selling out product. The eligible that come from paid profits. When building a large portfolio that we subject tax, it's important to consider the tax component because that will dictate what you're actually left with. If we're earning, say, we don't have, of course, we have 5% of the tax because tax rates are higher on your income. So when looking at how to construct a portfolio, how to invest on another basis, it's important to find relative tax applies to different forms of investing. All right, so the last couple slides, then we'll talk about some tax tips and planning, and then I'll be passing it back to Laura. For 2023, so far, capital gain tax rates are staying the same. So a lot of studies about capital gain inclusion rates, potentially increasing from 50% to 75%. In the year 2000, we started the year at the 75% inclusion rate, up to a 2/3 inclusion rate for a refund that went down 50%. It's been there since. So we've had a long track record of having 30% inclusion rate. But the government has suggested that could change capital gains to be taxed higher than now. If that changes, the big question is, if it's a sale and get that 50% inclusion rate, pay tax now, or keep things deferred to pay tax 5 years later. We may not have much need time to think the government decides to change those rules, and we really don't have crystal ball to know what the government will do if there changes there. But if you'd like to discuss this issue with us, it's feel free to back and feel free to look at our steps that we followed proactively. Today we get federal and budgets in March or April, and that's where we will learn what the rules will apply, what the rates will apply. So for private corporations, otherwise focus on corporation shares, should you sell them, their capital gains exemption for 2023 in Canadian structure tax $11,000 if you sell that shares. Because these exemptions still exist, there's some speculation that can change. Perhaps you reduce or eliminate if profits are significant as well. And if it's speculation, that's going to go into wealth tax. We have to go on the value of their assets as opposed to income and capital gains. Tax laws are new pretty much for December. We have
just a reminder, if you message using checklist the version of the PDF the word and Excel version available. Here's your computer release the that all options the and of course the presentation will be available on the website. You have to be sure to structure there. Please go to chapter 1 and we'll send you. So that's another previous and also in buckets you can put these the 45 and one of those set up there. So you need folders taxes back over folder federal sensitive and the third domain is folder there. And